Hi everyone, it's Grant Abbott speaking. Hope you are all well and welcome to this session. Just let it run out for a little bit. Put your hand up if you can hear me okay. I'm actually not using my computer recording anymore because I can't trust that. So if you just put your hand up or say something on the chat if you can hear me properly. So hopefully everything's okay. Thanks, Grant. Good to see you. It's going to be an exciting session, actually. I'm going to have a lot of fun with this one. Last few days, I've been doing lots and lots of training on wills and testamentary trusts, SMSF wills, family protection trusts, the protector, so on and so forth. So there's a lot there, but this one is really probably something that is really dear to my heart in that it's tax planning. So let's go forward and you're going to find there's going to be some great stuff off here. So I'm going to actually, hi everyone, it's Grant Abbott speaking, and thank you very much for coming to this session. We've got a really good solid hour block here that we're going to be going through a lot of stuff. You know, from this particular point in time, and I know you've been inundated everywhere. I was on a great session the other day with Mr. Tim Munro from Change Accountants, and he was going through some great stuff. I sort of touched on a couple of little superannuation things, nothing to any great extent. But now I've got this whole hour for myself, and being a tax specialist, well, I did a master's in law, specialising in both domestic and also international and cross-border taxes many, many years ago. So it's certainly something that is extremely dear to my heart. And 30 June, usually it's the May budget is the big one, but that's sort of bounced out this year with COVID, and it was a virtual free-for-all giveaway. Now we're coming up to tax time. And unfortunately, many accountants are actually going to be so super busy. The tax will be a really last minute thing. So I want to give you a few things. I'm not going to dwell on all the stuff that Tim did because his stuff's brilliant. Hopefully I'll get a recording from Tim and I can flick that out to you for you to look at. But really, we want to get in and start to look at a lot of super stuff. There's a lot of changes in there. I want to do a deep dive on the legislation so you're super comfortable, come up with some good ideas, some tax planning insider fun. And more importantly, starting to spread some stuff over a little way. So I know we've been busy with COVID pandemic, but look, this is honestly, I'm using, I can tell you, I'm using a lot of these strategies myself this year. So it's absolutely crucial to get things. But before I get some, there's a few little things there. We've got trust distributions. Obviously, these are some of the nasties you worry about, so I'm going to get rid of all of that. Michael did a brilliant session on that last week, and you can find that on our up in our strategy centre in Lightyear Docs. So have a look at that. He goes through our discretionary trust minutes, and look, I've been through them myself and did them for my trust, and yeah, they're absolutely brilliant. So he's done an excellent job there, and we've got to be really careful about making sure they're done before 30 June. Mind you, most of us don't. The problem is a lot of us use trust distribution minutes which are sitting on our server, or for example, Lightyear Docs where they're timestamped. So just be very careful on that one, because if you haven't got the minutes in play by 30 June, then effectively they're taxed in the trustee's hands under Section 98 of the Income Tax Assessment Act 1936. Can you believe that? They've got the 9736, they still haven't consolidated the two. One of the ones that I am going to look at tomorrow is in terms of the, which was raised the other day with Tim, and I'm looking at it tomorrow's session at 10 a.m. If you haven't had a chance, make sure you get to it. It's our hottest strategy for accountants and planners. The Protector tomorrow at 10 a.m. I've done a couple of sessions on it, but each time we delve into it, there's more and more that we find. Tomorrow I'm going to go through the base strategy, but I'm going to also going to look at the ability of transferring UPEs by way of a gift into a family protection trust. So that's going to be an interesting one, and really the more I develop, dive into UPEs, and I think we've really led our clients up not a garden, well, there is a garden path there. that can really create serious problems for us, particularly if they haven't been secured. Tomorrow, hopefully, I know Michael's a bit of a guru on this. He's been working with a couple of mates and super gurus about asset protection, etc. He's got to come and give his 2 bobs worth on PPSR, so how we can make sure that we secure our UPEs if we want. Sometimes we don't want to secure our UPEs if they're going to adult kids, but we're going to delve into that. We're going to have a look at a lot of stuff around that. So make sure you have a look at that webinar. Brilliant, perfect. Also, Div 7A, we're still waiting on the government supposed to come out with legislation around Div 7A. Remember, they're probably making changes for the last, 3 or 4 years, and always promised. It doesn't look as though we're going to get anything untoward around that or anything in the plate at the moment. Everything's just too busy with COVID at the moment. So unless you guys have heard anything, I'm not really sure where we're at. So Michael, yeah, it'll be great tomorrow to start looking at a lot of this protector. Like I'm just super excited. I just built one for myself. Anyone who's been married before, you'll need the protector. So let's move on to the next one, Div 7A. We've got a document up there, so feel free to use it. Particularly those guys who are on the on your unlimited plans. Use as many as you can. In fact, we had one group who I think in May or was it April they did $18,000 worth of documents in 1 month, and good on them. I think that's fantastic. Okay, so here's some of my hacks. Bang, I'm opening up the strategy door and out they come. Short of cash. Oh, how many times? I don't know if you guys have done it. Don't trust the banks because you just don't know what they're doing. Sometimes I make transfers at NAB and it pops over to like an ANZ account. I've got one with my daughter there, which has got nothing in it, but just help her to pay rent. It's my family allowance agreement. Most of you know family allowance is there in order to make sure that she's financially dependent. Anyway, sometimes it just pops over straight away. Then other times it takes like 2 or 3 days. It seems to be St. George's the absolute worst out of the lot. So sorry, St. George, but not my fault, it's your fault. So we can't guarantee that effectively we're going to get the old money over in time. If you have a look at the Commissioner's ruling, it's not until it actually hits the bank account that is to be included as a contribution. So it means that it's contribution in order to get a deduction that needs to be made. But you guys know all that anyway, so I'm not preaching to convert it. So when we have a look at it, we need to, I'm having a look at now with the leap year, 30 June is on a Tuesday this year. You look at it, if you're trying to get business days, you're going to have to get in on the 26th at least. And then you got the weekend and hoping it gets in on Monday or Tuesday. Anyway, look, I don't worry about that. Better still, just go in, rip out a promissory note, put it into the fund. The funny thing is, press it in, bang, 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 bang. The member or the employer gives it to the trustee who's themselves, and as soon as that is received, it's equivalent to a cheque. The Commissioner considers it the same as cash. Go and have a look at the contributions ruling, or send us a note, we'll show you that. Then you've got the promissory note. Then after year end, if need be, then pay the cashola at that time, or an asset if you're actually doing a transfer of an asset. So promissory note is probably the best, and I've made a few 10 p.m. on the 30th of June promissory note contributions. So again, you can ride that with both the promissory note. You can also find on our site the contributions as well. So there's, we've got both sides there. Year-end pension payments, obviously, probably you're not going to have a huge drama there anyway. So this is a bit of a nasty. But what I would suggest anyway, if you have a look at this one, year-end pension payments commutation, you're going to find in our kit, our account-based pension kit, I've actually put in there 2 buttons. And for those of you who use it, our buttons actually are not there just for a button. They lead to specific drafting inside a clause. So inside a document. So for an account-based pension, which is a legal document, has the force of the governing rules of the fund, which is important because that's also not only is it protected by the SIS Act, it's also protected by the Commonwealth Crimes Act, which is great. So what we've got there, though, is if you do have a minimum pension payment shortfall, that shortfall is to be deemed as a promissory note paid from the fund to the pension member. Again, it's got to be short term. With promissory notes, probably maybe 1 or 2 months you get away with. The danger with an SMSF is a promissory note effectively is a promise to pay. Classic one, we all know. So, for example, when dividends are declared, there's a promise to pay that dividend out over a period of time. So it's a deemed promissory note, which is basically where I got the idea from. So when we have a look at that, we don't want to go too far down the track because effectively it'll be treated as a loan to a self-managed superannuation fund. And that's where we start to get into the LRBA, which obviously is not going to work for us. So, I've seen some auditors say, look, it has to be by 31 July. Some go 2 or 3 months on the PNs, but, it's up to you. So just be on top of that. But, it's better to have it rather than not have it. In terms of commutation, you can press a button there and anything over and above the minimum pension payment is to be treated as a commutation. And for me, that's a good one. In fact, I've used that myself inside both of my self-managed super funds. The reason for that is effectively it winds back that amount in the pension. In fact, I'm running my SMSF pretty clean at the moment because I've put a lot of money into obviously Lightyear Docs, Lightyear Group, which includes I Love SMSF. And what I've done is I've preserved my T-bar at that stage because what's happened is by making commutation payments, I get a debit against the T-bar. So that's something that is worthwhile, and obviously my general transfer balance. Now, TRIS, the most boring things, but if you've got to go to TRIS, thank goodness once preservation age gets up to age 60, we're not going to have to worry about TRISs anymore because once you're 60, just show one form of gain, give up one form of gainful employment, and then bingo, bango, you're right in the pension stage. So with the TRIS though, look, what happens is you're not getting the pension exemption. So I would, de rigueur, I'd be setting up TRISs for the year and then closing them down. So at the end of the 30th of June, you don't see a TRIS sitting on the balance sheet of the fund or in the members' benefits. So all the members have either got accumulation or pension, and that's it. So, and then if you want to start it up again in, 31st of July, whatever, do so, whatever. But it's not a bad idea, remember, because at the end of 30 June, we've done our commutations, we know where we are. We've probably got our TRISs, we're working it out, and then effectively what we can do is we can stop it, recalibrate, and we can also start again. So typical tax strategies. Again, Tim did a great session the other day, and what I'll do is I'll get that recording for you and send them on. But Tim knows it all, and you got your bucket companies. Look, you all know your bucket companies. I don't think we need to say anything about that. One thing though is if you do have a bucket company with a lot of UPEs, it's worthwhile getting the equity of that bucket company and transferring it into Family Protection Trust by way of the protector, either that or the UPE itself, and I'll cover that tomorrow. Another one not many people think about, and I remember having a chat with a good friend of mine, Robert Richards, many years ago, and he's saying, look, I never understood why people just don't distribute straight from a family trust into a self-managed super fund. Now, a lot of you are saying, well, hold on, that's not arm's length income, which is true. It's taxed at 45%, but it's not to be treated as a contribution. It's simply going to be income in the fund, be distributed proportionally like any other earnings in the fund. Whether to jump the firewall, and I don't know how they treat it in terms of pension income, but essentially it is income to the fund. Hence, it's not arm's length income. It's not a capital amount. And part of that is that it would be taxed at 45% of the fund. But look, if you're using buckets, then obviously your rates are going to be down at 30%, possibly 27 or 27.5 or whatever it is under the current situation. So again, just be really careful about that one. But it's a nice sort of one to have if all things are desperate, they're making too much money. Don't hurt to have a look at money going into the fund by way of a distribution. You're paying high tax rates, but it's not a contribution, which is important. Prepayments, obviously, I think we all know about that one. Certainly inside a self-managed super fund, prepay your audit fees. I don't know why the auditors don't do that. Prepay audit and also accounting administration fees if they're looking at doing that. Deferring income, just watch out. Obviously, JobKeeper. I don't know if you saw that today. That the ATO is having a bang at. I forget the name of the company, but it reduced its income down by deferring, obviously, invoice, etc., and ended up with $11 million in JobKeeper for its staff. So, of course, those sort of things are going to poke their head up over the next few years. I can guarantee that one. We're going to see a lot more of that investigation of JobKeeper, etc. So the stuff that we're doing, we're pretty good. Instant asset write-off, obviously, it's up to $150,000, but whether people have got that or not is an issue. Okay, let's go and have a look at some super contributions. Then I'll go into the law. Then we'll go through case studies and have a look at that sort of stuff. So the first one, obviously, is the $10,000 withdrawal. I have seen a few people, I know Ashley at our office has gone through that process. She's got a self-managed super fund and they notified her straight on the first day because obviously the tax office has got all the details. So if you're in an SMSF, it's not a bad idea for anyone who's under age 60 to take out that $10,000 because it's completely tax-free. I mean, why would you possibly take out a TRIS payment, which is, if you're under 60, is assessable with a 15% tax offset, when you can actually withdraw $10,000 tax-free? Look, I just don't even understand why people aren't using that. So, but what we will find is 30 June is poking up, and there's a lot of people who have yet to avail themselves of that $10,000. So I'd be going pretty hard on that one. At least send a letter out to clients on that, the importance of it. As you can see, the industry super funds are, they're obviously, I don't know about you guys, but I don't trust anything in the media anymore. I think everything is jaundiced, or effectively there's lobby groups paying for someone somewhere along the line. So I always like to do my own research. So when I see that, can you believe this? According to statistics in the New Fund Daily, which is just a commie rag put out by the Union Funds, 11% of all withdrawals from the $10,000 withdrawal amount, again, no tax, it's fantastic. I don't know why everyone's not doing it, but 11% is used for gambling and other nefarious purposes, which I don't believe at all. I mean, how is that possible? So Dennis Lim, how about Tris? Can you reduce the withdrawal by 50%? Yeah, so you can reduce it by 50% if you want to go ahead and do that for your minimum pension. But as I said, it's quite easy for Tris anyway to start it up and work out what you basically want. But I'd be going for the $10,000 withdrawal because there's no tax benefit. But obviously the pension stuff does have an impact there, Dennis. Again, just going back, Dennis, you're absolutely right. So well done. The other one, as I said before, there's no way 11% of all the money that's being withdrawn is using for gambling and nefarious purposes. So, look, I just think that's crazy. The other side, though, is there will be a mad rush at 30 June. So as long as it's into the tax office by 30 June, you're sweet. Even though it might take months to process, which I don't think it is, although obviously you can tell the industry funds are putting their brakes on pretty heavily. What's going to be the big one is 1st of July, you're going to go for the double dip. And that one will be pretty scary. So I'd be going sooner rather than later if you've got clients, because you never know when it just might get to a stage that they might just say, look, it's instead of September the 26th, it's going to close on, for example, the 30th of August. So just be careful on that one. Go for the double dip. It does make a big difference. Even if your clients are like 35 or 40, don't need to pull it out and put it in the mortgage. It's going to have a lot better impact at the moment, because then they can offset and pull it out whenever they need. They can always fling it back into super. In fact, it's probably not a bad idea. Hold it until the market goes right down in the next couple of years and then put it back in. So just make your choices. So this is a once-in-a-lifetime offer, and it truly is a once-in-a-lifetime offer. In SMSFs, probably a little bit different, but again, so how do you get 10,000 back into super? You contribute not if you are over age 75. It's obviously you can't put it back into super, unfortunately. So that's one of the downsides. Although we'll look at the related party loans a little bit later on. Super contributions, ideal for trust distribution. So I'm going to look at both the personal and also the employer, but currently we can utilise both. Though we're going to limit it, or the former or the Labor Party, if they got in, we're going to limit it just to employer. But now we can bounce around. So there's no difference between I make a personal contribution or employer. So, for example, if I've got a discretionary trust and I contribute down to my father, for example, then he can make a contribution to super, provided he's under age 75 and meets obviously the contribution rules. And I'll look at that a little bit later on. So it's going to be assessable income in his hands, and then obviously the contribution in is going to be tax deductible. So again, I find super contributions are better than bucket companies. It's somewhere along the line, someone's going to have to pay the piper for bucket companies. And quite often, if we're going to use the money, whether it's directly through the bucket or it's sitting up in a UPE through the family trust, obviously with the new Div 7A rules, that family trust would be treated distributions would be treated as a deemed dividend. So you're going to have to do Div 7A from a family trust, but that's coming down the track. Transferring shares into an SMSF, I'm going to look at, and using personal contribution to offset and employer contributions. So these are some of the things that I just wanted to give you a bit of a heads up and have a look. So the first thing is we want to have a look at the relevant sections. So hopefully I've got, I must have section 291. Okay, so I've missed the tax deduction. So they're going to be very special. So here I am, I'm actually going to bounce straight into the Superannuation Act, Super Tax Act. As you can see here, I'm going to look at tax deductibility of contributions, if you don't mind. It's better to see, you know my philosophy, it is always read, understand and apply the law. Don't go onto websites and, Super Guide or Tax Office I love going on to, because, they're usually pretty good. But obviously you can have strategy, or they do sometimes have some really great strategies on there. So that's 290, we want 291, we'll look at section 290, which relates to concessional contributions. Sorry, it was in my slides, but I must have bounced it out a little bit later on. So what I want to do is have a look at the employer contribution. Pretty simple. There's the deducting the personal contributions. And there we go. Don't you know, isn't it great that I know a lot of this law? It's a bit scary, actually. Anyway, here we go. Okay, so section 290-60-60. Let me just open this up for you so you can see it. Oh gosh, that's a bit brutal. I'll just highlight it for us. So this is an employer contribution deductible. You can deduct, contribution you make to a superannuation fund for the purpose of providing super benefits for another person who's your employee when the contribution is made. Remember, that's the made. You can use PNs or promissory notes for that. Regardless whether benefits are payable to assist dependent of the employee if the employee dies before or after receiving, after becoming entitled to the benefits. So there's a whole lot of conditions. Again, you can only deduct the contribution for the year in which it's made. Application to employees. So at a time when an individual employed the entity within the expanded meaning of employees, that includes obviously directors as well. So if you meet that, even subcontractors, if someone's working as a subcontractor for you, so they are treated for SGC in the expanded meaning, then you can, instead of them taking money, you're better off salary sacrificing. For me, salary sacrifice is the way to go. Just make sure your employment agreement for your client for that year allows the ability to salary sacrifice 100% of their superannuation or their salary into super. Employment conditions, to deduct a contribution, the employee must be your employee, as I said, within that expanded meaning, or engage in producing your assessable income, or an Australian resident who is engaged in your business. So that's for overseas employees. So any one of those, the employer is going to get a contribution. Of course, you've got to make sure that it's complying fund. So that's a pretty easy one. So that's for employers. Let's go down to the personal contributions. There's a few little tweaks around that, or I'm not going to go into because most of you know those sort of ones. So deducting personal super, we're looking at section 290-150. So these used to be mutually exclusive. Remember the old 10% rule, but it's not anymore. So you can deduct a contribution made to a super fund for the purpose of providing super benefits for yourself, again, regardless whether the benefits are payable to your sister dependents if you die before or after becoming entitled to receive the benefits. So again, there's a whole lot of conditions. I won't go into much. I will stick to this one. Obviously, the time in which it's made. We go down to the contributions made for a complying fund. Importantly, age-related. Again, so if you're under age of 18, this is a good one, at the end of the income year in which you make a contribution, you must have derived income in the income year from the carrying on of a business or attributable to activities or circumstances resulting in you be treated as an employee. So that's a really good one. I like that one because, for example, well, I probably wouldn't. So if you have children who are under age 18 and they're sitting in a family trust and they're generally working, then effectively what we can do is make a contribution on their behalf into super, and I'd be using 290 or 60 and getting an employer contribution. It's not commensurate with the amount of work that they do. So effectively I could make a $100,000 contribution, a deductible contribution for that child if need be. Alternatively, I could distribute it down to them and then get a deduction for them from that perspective as well. The other one, so obviously not downsize, you can't get a deduction for downsizer. The main one here is 290-170. So in order to deduct the contribution, you must give to the trustee of the fund or provider in approved form, which you give for the tax office, that must be given before you lodge the income tax return for the income year which the contribution is made, or otherwise at the end of the next income, the trustee provider is giving you acknowledgement. So basically what you're doing there is you're saying, look, I'm going to deduct this amount. So that's look, we're going right to the hardcore law there. And again, just to keep on that theme, what I'm doing here is I've just extracted this legislation. I will put those other sections in there for you as well. These slides and also this video will be available after this, which you're generally going to want to have a look at a couple of times because I've got some really good strategies coming up. Anyway, concessional contributions. So we've made these contributions in. There is, as you can see, I just went through the law. There are no limits. If I went back to 2007, so that's a long time ago, gosh, that was the last GFC. So prior to 2007 or 30 June, there were age-based limits on contributions. If you're over age 50, it was $107,000. $107,000 was the age-based limits. There are no limits at the moment. So effectively, you can make a contribution into super as much as you want as an employer and get a deduction. So, for example, my employer for my my wages, it's better for me is just to do full salary sacrifice. So it goes straight into my superannuation fund, and then I deal with my tax inside the fund, which we'll get to. Now, of course, I've got a $25,000 cap, as we all have. Going forward, we're going to have unused caps, but that's going forward. At the moment, for the year ending, I think it's the 1st of July 2019 is the first year that we have that unused carry forward cap. What we've got here though is a big change. So from 2007 until 2013, that 6-year period, any excess, so again, if I put in $100,000 of full salary sacrifice into my superannuation fund, so I've got no PAYG, no wages, and that's perfect because it's sitting in my super fund, goes in the accumulation side, I can just pull it out whenever I want, pay my kids' school fees, pay all that sort of stuff because I'm over age 60. So I've got full access, comes out obviously tax-free. So I just run my super fund like a bank account, a personal bank account, put the money in, pull it out, pull it in, pull it out. So obviously it goes in pre-tax into the super fund. So how does that work in practice? So I'm going to give you a few little tweaks and variations what I'm doing, and that's going to apply to the case study. So the first one is, obviously I've got a cap of $25,000 for this income year. Next income year, I've got 25,000. Following income year, 25, unless they start to up that cap as the CPI increases. But I can't imagine it's going to happen for a while. You never know. Anyway, currently, so what will happen though is you can see with 291-15, I'll just get my little annotator here because I like to have a little spotlight. You can see here, if you have excess concessional contributions for a financial year, so that's, for example, me. So remember, going back to the basic, I put in $100,000 this year. My employer's got a tax deduction, which is obviously the light year group. That's how much, it shows you how cheaply I work for the light year group. But anyway, so I put $100,000 in, $25,000 is my cap, $75,000 is over my cap. So what's going to happen? Well, if you have excess concessional contributions financial year, an amount equal to the excess concessional contributions is included in your assessable income for your corresponding income year. Does that make sense? So what happens now is, and this is really important, get the timing right. My PAYG and my personal return would show zero. So I don't even have to lodge a return if I'm a zero return. But let's say I lodge a return. It shows that I've got zero taxable income. I may well take enough salary there, and I want to show you a little bit later on. I might take enough salary if I've got some expenses. So if I've got deductible expenses, I take salary up to that, and everything else will be salary sacrifice. So then I've got the 25, but I'll assume that that's not the case. So 25, 100, so that means I've got $75,000 of assessable income. Is everyone happy with that one? So what happens with that one is then I will lodge my return at some point in time. Let's say it's just 31st of October. And then my superannuation fund will come around to lodging its return. In its return, it'll actually show $75,000 of assessable contributions. I'm going to look at that a little bit later on. So it shows $75,000 of assessable contributions in the fund. Now, remember, I'm taking this money out, whatever I want. It's my bank account. I just use that, much better than the family trust or whatever. So it goes in there. I'm pulling this money out. Now, the $75,000 excess is going to be added back. So my trustee in my superannuation fund will let the tax office know that I'm lodging in March 2021. So we're going out to 2021, which seems a long time in the future, but who knows what's going to happen between now and then if this year's anything to go by. So I lodge that, then the tax office will then come back and say, look, Grant, we're adding back $75,000 to your assessable income for the year ending 30 June 2020. So that seems to be A-OK. And then we will determine the tax payable on that. So if I have a look at the tax payable, and then it's going to be around about $7,300. I mean, I can do it pretty basic for you. I think I've got, well, look, I won't do it. It's going to be about just $7,000. Now, what will happen though is, this is where it's crucial. I will get the low income tax offset and low to middle income tax offset. So that gives me a bit of breakage. But also you got here, you are entitled to a tax offset for that income year equal to 15% of the excess concessional contributions. Does everyone get that one? So what they're doing is they're bouncing, they're saying, look, hold on, all that amount that's going in, particularly the excess, is going to be taxed at 15% in the fund. So when it comes out, we're going to give you tax offset. So when I take out the 75 or thereabouts, so the excess, if I'm just living off my superannuation inside my fund and I've got no other capital gains or any other assessable income, and I can do this again for capital gains, which we're going to look at, because I can get a personal contribution by, remember I showed you before, I could be transferring shares into the superannuation fund, claiming a personal deduction to wipe out the capital gains, and I'm doing exactly the same thing. I'm going into excess. So you'll find that on the $75,000, $100,000 I've just put in, I'm going to be paying no tax. I'll be paying no tax at all. And some of you might say, well, hold on, what about the excess concessional contributions charge? Because you can have a look here. Note 1. Does everyone follow that one? So, I mean, it's pretty stock standard. It's good to read the law because it actually says things and then they give you notes. The offset cannot be refunded, transferred, or carried forward. So you want to make sure that you only salary sacrifice a certain amount, because a 15% tax offset is quite beneficial. Now, of course, carried into that $75,000 is my tax-free threshold at that point anyway. So I'm loading it up into my salary sacrifices better. You may be liable to pay excess concessional contributions charge, which is around about 6% based on your added back tax payable. But if I've got no added back tax payable, then note 2 also goes. Now, here's a good one, note 3. You can request the release of excess concessional contributions. Now, I'm not going to do that because I'm like in my little super fund bank account, but can you imagine if I was in exactly the same position, but I was 45? So same deal, same figures, nothing, but obviously I'd need other money to live on because I can't access it from super, and it's, unless I've got that, the government system. Now, what it means though is I've gone over 75. So how much can I pull out of the system? And this is why I love excess concessional. I think it's the best way, after obviously the $10,000 rule, getting access to money from super. So what I do is I just punch into my little calculator, which is now sitting on my phone. I do $75,000. So I'm just going to get that. So $75,000, and I can take 85% of that out as a release. So $63,750, if I was age 40, did all this trick, I put $100,000 in, I can pull out $63,750. Now you might say, well, this is a crazy strategy. It's not a crazy strategy. If you've got family trusts and you've got parents, you've got family trusts and you've got a spouse who's not working, hey, this isn't a bad strategy going down the track, because not only can you put the money in, and if they've got only $75,000 added back assessable income, then they're not going to pay any tax, but they still get their money back. I mean, I just can't do it. What you're going to do is focus heavily obviously, we want to focus heavily in on minimising the tax inside the fund. Now, non-concessional, a little bit different. So for non-concessional, obviously, if you go over the non-concessional caps, so for me, if I can just go back and take you, so my cap was $25,000, $75,000 excess. That excess is actually treated as a non-concessional. So it means in this year I've got $75,000 for non-concessional. If I wanted to top it up, I'd put another $25,000 of non-concessional because my cap's 100. Next year it's going to be 100, and then I've got obviously I can use. There's no way I'd go over 100 now because I don't want to use the bring forward the 3-year bring forward year rule this year, because I'd rather do 100 this year and then start the bring forward 3-year bring forward next year, because that would then give me 2021, 2022, and 2023. I can put in 100 for each of those periods of time. So if you have a look at it, I won't go into that, but if I exceed my non-concessional, then what will happen is I'll be taxed at my top, the top rate, unless I'll get a release authority from the commissioner that I have gone over my non-concessional. So that's not a bad one. Obviously with non-concessional, likewise, there's a deemed an amount of accrued income based on that excess amount, which is to be added back, as you can see, added back to assessable income, and it has a 15% tax offset. So that's what happens with excess. So look, at the end of the day, I don't really care about excess. In fact, I like going to this Supermax. Same way family trust spread, bang, use your family trust to spread and your family super fund to minimise. Again, I love this excess concessional, being able to pull out 85% of the excess amount, 85% of the excess amount. So that seems a pretty good situation for me. So yeah, Drew, I will do the copy of the presentation slides for you, and also the video. I'll shoot those off to you really short. I just need to fix up that one so you've got that other section in there. Okay, so now the fund is assessable. The assessable income of an entity, so this is super fund, provided it's complying, includes contributions or payments as set out. So for a CSF, which is a complying superannuation fund, non-complying, then a contribution to provide super benefits for someone else, obviously excluding rollover. So item 1 of 295-160 would included in the assessable income of the fund. Now, of course, industry and retail funds hoodwink and say, hold on, there's a 15% contributions tax. Now, I can't see anywhere in there there's a 15% rule. What it is, it's assessable, we take off deductions, so on and so forth. Now, the other little twist I've got here is a contributions suspense account. And the Commissioner's got reserve rulings on that. You'll find on our site, again, you can build all this stuff on our site. There's nothing I tell you that you can't build on the site. Trust distributions, the protector, making contributions in, employer and also employee. Haven't got time to do this. I might do this later on prior to 30 June so we can get all our paperwork. Your promissory note, everything can be built, and your contribution suspense account as well. So this is a SIS. Actually, sorry, let me just go back. I'm very remiss. I'll put in here, Drew, for you. This is the Income Tax Assessment Act 1997. This is the SIS SIS regulations. So the SIS regulations. So what it says here. So let's just play with me here for a while. So I'm going to forget about the added back. I'm going to put $50,000 into super this year. So it's going to be my employer, $50,000 salary sacrifice. Remember, I've gone through here. Remember I did that section. No, and normally that would be a $25,000 concessional contribution excess, and so that would be added back. But what I can do is I can put in $50,000, and the way I would do it is I make my contribution first for the $25,000. If there's an employer, that is then fully deductible for me. I then make another $25,000, but what I would do is I carry it to a contribution suspense account. And again, the Commission has given rulings on this. You carry it forward, you use the Light Year Docs contribution suspense account. If you don't know where it is, just give me a call and I'll show you where it is. So what happens there? So remember, as I said before, if it was all in 1 year, it's still all deductible, it's still all accessible in 1 year. But what I'm doing is I'm floating it up into a suspense account. So for the employer or the individual, it's still deductible because it's made. For the superannuation fund, it's actually payments which are made. So effectively, it's accessible in that year. But when we come around to contribution suspense account, I put it up into a suspense account. The Commissioner doesn't like calling them reserves. That's why I call it a suspense account. And then it says here, this regulation applies to a trustee regulated fund if the trustees receive a contribution in a month. So I'm doing this in 30 June. 7.07H and 7.07G do not apply, which is not the case. And the trustee is not required to allocate the contribution. This is under defined benefit funds. So both of these regs here apply to situations for basically retail and industry and public sector funds. It doesn't apply to self-managed super funds. If you have a look at those, it says excluding self-managed super funds. So where we drop into is sub 2. So it says, for subsections 31 of the Act, the trustee must allocate the contribution to a member of the fund not later than 28 days after the end of the month. So, and we can, for example, an employer, if you've used our contribution suspense account, you can just glob a whole lot of money in and then allocate to members by July the 28th. Does that make sense? So I'm hitting everything in June and then it's going to come out in July 28th. So I'm crossing that income year, which is important. So you don't want to do a contribution suspense account in December and throwing it through to January because it's like, well, who cares? Well, what was the purpose of that one? Now I'm crossing the barrier because what I've done now, do you understand what I've just done? I've put in 50, taken a deduction. I've got to work on the deductibility, not the income expenses and the tax liability in the fund because I don't want to pay 15%. So what I do is I transfer it in, but 25's in and 25 goes up into a suspense account, which is then allocated in July, which now means it's a 30 June 2021 contribution. It's still a contribution, but for excess purposes, it comes down as a concessional or an excess, not an excess, a concessional contribution under the excess rules for 30 June 2021. I've leapfrogged that year. And again, I can think about 3 or 4 different rulings from the Commissioner. I can show you those if you want. In fact, I might put those up on the side as well. So when we go through, in fact, actually it's in the contribution suspense account documentation talking about it as well. So I've included in that. So what happens is it bounces over. So I've got 25 this year, 25 next year. So without anything further, I effectively have not breached any of the caps because I've just simply carried it forward, but my deduction is for the current year. So pretty sweet, isn't it? So I can do that with NCC. I can also do that with concessional. Now, what we want to do is we want to get some strategies in there as well and have a look. So as I said, your concessional contributions don't have a cap. It's simply added back of assessable income. I have got a fully worked strategist article, which I might send through if anyone needs be. One of the good things is by jumping over to 30 June, 2021, on the 1st of July 2021, I've got new contribution rules which apply, which essentially is like that 3-year bring forward cap that I can use to determine my excess concessional. Now, again, this is not deductibility. Deductibility and excess concessional have to be split apart. So by carrying it forward, I can actually look up to age 67. Does that make sense? Depends on how they haven't drafted it yet, but from the 1st of July, there's no work test up to age 67. And then from 67 to 75, we just have to show that we are engaged in some form of gainful employment for 40 hours over a 30-day period during that year. So let's move on. And I think I've got a nice little case study. Oh, sorry, before we keep on going, we want to minimise the tax in super. Good one that I like is an early stage innovation companies. And I know a lot of our strategist advisors get into those. Look, the best thing is a 20% tax write-off and CGT exemption if it's disposed within 10 years. Obviously, you have to wait for the first 12 months, but an early stage innovation company would be very unlikely. Another thing is there's a lot around, but there's a lot of crap around. Just to let you know, we're going through a little small capital raising. In fact, half of it's gone already, and it's only been up and running for 24 hours. But if you like an IM, give us a call because we're right in that sweet spot up to 30 June. We're in ESIC. Post 30 June, we can't because our revenue is too much. But look, we've got to prove a bit, if you're using us, our business model, we're cash flow positive and super, super low valuation compared. We're 1/10 of the valuation of Now Infinity. So work that one out. And if that's not a good deal, then let me know. Instant asset write-off, look at that, and depreciable is okay. Investment strategies, make sure you're completed for the 1st of July. And look, we've got lots and lots of our advisors are actually upgrading their client deeds. We've got a perfect email to send out for that for the clients. Look, it's not a bad idea because that way it's going to be deductible for this year as well. So I'd upgrade the deed, do the whole enchilada. But let's go on and get a really good look at our case study as well. And again, if you've got, if you want to have a look at IM, have a chat with Michael. So we've got quite a lot that's been allocated already because it's a super good deal. And you can see there, I'll show you a couple of numbers. So let's have a look, and I'm going to play it out for you. I've got 15 minutes. So I've already given you a good preemption looking at my strategies. We've got a client who's 65 years old, but this could be like 45 or 35, doesn't make any difference. They're retired with an 800K share portfolio outside of their fund. They've got $400,000 in capital gains. So that sounds like you, Mr. Goot, right in that sweet spot. So that means once we take our 50% deduction, 50% CGT exemption, we're down at $200,000 of assessable income, which is still quite a lot for a lot of your clients. It would freak them out. I want it to go into super because we're going to have a lot of fun with this. So here's my solution. The first one is that they contribute 175 concessional contribution this year. Now, the 25 that's left in the hand, effectively we've got zero tax on it with Listo and also our obviously tax-free threshold in there. So again, probably the best is, I think you can do this under Tim's Tax Plan Plus, but look, we're transferring it in. So I've got $175,000 concessional contribution, leave 25K in the hand. So no tax in the current income year for our client. So it's the same way with me. You're basically taking out the tax for the current income year. Now, the 175K going into the system is obviously accessible. Remember, we did that one a while ago. So it's accessible there into the fund. Now, obviously, you can reduce your tax liability, but look, if you have that, your total tax liability is 26,250. It's hard to get enough deductions because there's only so many you can prepay interest if you've got LRBAs, prepay expenses, but they're only going to have like a 15% effect, whereas your ESIC investments are 20% tax offset. So you need to get rid of 26,250. So if you had 100 in a 100 in an ESIC or a range of ESIC investments, that's 20K gone now. So what I've done is I've transferred 175 concessional contribution this year, and I've also put in $100,000 in this year's NCC. Now, I've still kicked in the 800K, so I'm not going to do anything, but what I'm doing is just chopping it up. At the end of the day, I'm going to end up with my max cap of NCC this year, which is 100, my max cap of what is it? The concessional of 25 in there. I'm going to use a related party loan, which I'll show you how to work out. And everything else, I'm going to suspense it. So put in the contribution suspense. So what I've done now is I've transferred everything in. Now I've got to work out the documentation, and please make sure you do that prior to 30 June. Get your documentation down, get it all executed. You can, for most part these days, just do digital execution. If you have a look at most states, and certainly the Commonwealth government's come out and said that you can do digital execution, even witnessing. So in the suspense account, what I can do is I carry over a 25 for next year's concessional contribution. I've got NCC will be 3 years draw forward. I'm hoping that's the case because remember, we're jumping up to 67. Our client is 65. So much the same now. If I make a contribution at age 64, I can use the 3-year bring forward rule. So I need to have a look at that one to play out. As I said, these are numbers. If I actually made the figures 62, which might be a little bit easier for me until I get the thing. So I'll just make it, the client is 62 years of age. The reason I do that, it just stops me having to worry about legislation that hasn't been passed. And I'd rather give you safety, certainty and security on that one. So what we've got is NCC, we've got 300K, which is in suspense. Now, excess concessional is NCC. So what we've done is we've answered for 50K allowed concessional over 2 years. So what that means from my perspective is, remember we put in 175 as concessional, 50 is under the caps. So that now means we've got 50, we've now got 125 over the caps. What will happen is that will then be included in my assessable income for 30 June 2021. And then by the time I lodge my return, which will be May 2022, I'll have to add that back to my tax liability. So from that perspective, look, I've taken my deductions for this year anyway for NCC. The added back takes over next year. But if my income tax liability is wiped out, I probably would split. In fact, I wouldn't drag so much excess concessional to the next year. I'd pull it back a bit. So I'll just tweak these a little bit before I send them out to you, Drew, and everyone else. So what I've got there is over the 2 years, and then I've got $400,000 concessional over the 2 years. Now, what I've done is, and I'll just tweak it a little bit, but look, anything else that's remaining, then I can use the Commissioner's related party loan under 216/5 using the safe harbour rules. And again, because it's less than 50% of the total value of the $800,000 amount of shares put in, then effectively what we can have there is we can use the safe harbour rules. So I think it's about 7.9% interest rate, 50% LVR, and it's a 7-year term. You've got to do P&I. So that's all included on you'll find that in our strategy automation, a related party for shares, which is sitting up on our site, which is great. So again, I've managed to do all of this, and really we have got no tax payable out of that whole situation. We've covered our NCCs, we've used our concessional. I'm just going to have to think about that, tweak a little bit straight after this. Anything else we can then use as a related party loan. So now, obviously, if the share is held jointly in a couple, we can do the same thing. So we could actually get rid of, 1.6 million. Now, a lot of it's going to depend on what you do, but I've taken it to a certain level. It's all fully worked, so it's all okay. If clients are under age 55, start with the loan amount, because remember, the loan amount is effectively going to be the amount they'll draw out a little bit later in time. So again, it's like this $10,000. It's always nice to put money into super and know you can access it at a later time. Plus, if they need that short-term money coming out, obviously you can take out 85% of that excess concessional contribution. So you've got a couple of play arounds there to go in. But you've got the best of all worlds for the clients, because not only are they getting rid of the capital gains tax, they're getting the tax liability. And this can apply to also clients that may well be getting bonuses or anything. They might have a large capital gain they've realised this year. So really, there's no age limit. It can go up to 75, but obviously the three you bring forward, you can still do your related party loan at any age. But again, if you want to fit under PCG 2016/5, you've just got to make sure that it's 50-50. You can use business real property for transfer, or if you've already got a 1322C trust between your family trust or as an individual, there's obviously going to be no mortgage in that trust. It can have property, and it can be resi property, as long as a member of the family is not using it and it wasn't originally owned by the member in order to circumvent Section 66, then we can transfer those shares in at any point in time. So we go through the whole enchilada that we looked at a little bit further. Here's a nice little one. We might have a motor vehicle sitting in our family trust or a company which is fully depreciated. And then what we can do is we can transfer that into our self-managed superannuation fund as a contribution. It would be treated as in-house asset because we want to lease it back to the family trust or the company. And then what happens from there is that when we lease it back, we'll be treated as in-house asset, but we can't transfer it in. But at the time we transfer it in, it can be no more than 5% of the value of the fund. So I've got an $800,000 fund. Then I can use, for example, $40,000 of the cash in the fund to buy it, or I can contribute that asset over. Again, it's only a small amount. Once we do all of this, we can do it with business property, resi if it's in the 1322C trust, in-house assets. It's not a huge amount unless you've got a huge fund. And then what we do is we commence a pension in early July. So once your contributions are allocated, you commence it. You've got your share portfolio with franking credits, and look, gosh, you're off and you're off to the races. So look, that's a pretty sweet deal to me. I mean, when you have a look at that, that's really bringing in a lot of stuff. And the closer you are to age 60, it really makes a difference. But you can pull it in for someone age 30 or 35, because remember, 85% of your excess can come out. Plus, you can also put out that related party loan. So this is probably one of my favourite 30 June strategies, because I can do a bit of a straddle, use the suspense account, and basically doing all that. We've got a protector session on tomorrow, which is at 10 a.m. Make sure you pop along to that. Michael's going to give us a bit on PPSR, which would be fantastic. Tim will come on and talk about what he's charging for it. He's in fact just done 5 or 6 of them. So he's going to give a practical guideline on doing this for clients, how he approaches it. So that's really good. Look, I've got it in red. I love the protector. Everyone loves the protector. If you ain't protecting, it's the best thing since sliced bread. 2-day virtual strategy summit. For those of you, because you're all our members, it'll all be free for you. We haven't worked out what non-members will be paying at this stage, but we've got some great speakers. The beautiful thing about having a virtual summit these days is you don't have to pay accommodation, airfare. People aren't out of their offices, so they can pop on. So we've got some awesome speakers. Michael's lined up some great ones. I've got a few. Ash has got a few. So it's going to be a really good couple of days there. So watch out for that. All be recorded. You can jump in and out of sessions, do whatever you want, but it's perfect at the start of the year to really set in place our business and our strategy planning for the year. I know Tim Munro's also got a mastery month that I'm going to appear on during July. We're going to be looking at SMSF wheels, a whole lot of stuff like that. One of the things I am going to start building up, because I'm doing a lot of training sessions around wills and SMSF wills, I'm going to be consolidating, doing a weekly training session on wills, SMSF wills and testamentary trusts. I'll do them all in one session. And then what we're doing is we're going down to a situation where we're going to be able to do micro accreditation. So you'll be able to be an SMSF will expert and get you a little accreditation on that. So that's going to be a lot of fun coming down the track. And because there's a lot of nuances, it's also good for us because you'll have good feedback. They're only small sessions, and already we're starting to see our wills and testamentary trust and estimates of wills start to develop like investment strategy. They're not stock standard. You guys come up to us with certain solutions, and they're off and running. Now it's right up to the end of time. Look, I'm hoping I hope you've got a lot out of it. I'll send this out, and also I'll send this out and I'll tweak the slides again for you, Drew, and we're going to have a lot of fun with this. But make sure you get in before 30 June. You've got all the documentation is available up there. If you haven't seen how to use the documentation, for example, a PE, promissory note or contributions, you go up on the Strategy Centre and there'll be slides there for you. Look, I might even do a bit of an email out on this, a client email before 30 June, so you can send it out if there is a bit of demand. Anyway, thanks a lot for attending. It's Grant Abbott, and time to sign off. If I don't see you before 30 June, have a great end of year. Gosh, it's been a cracker. If next year's like this, look, who knows what's going to happen. But anyway, it's Grant Abbott signing off.